Hey guys, what's up? Everyone there? Sorry I'm late. All right, I almost canceled this live stream. I'm tired. I'm not feeling very good. But anyway, I was going to do it at 8:30, but then I made it till 9:30 and I rested a little bit, hoping I'd catch a second wind, and I kind of halfway have. Anyway, how's everybody doing? I have the graphic all lined up. We're ready to go on the closed end fund Friday night. Jackson, do you want a treat, buddy? Do you want a treat? Well, you got to come up here. You got to come up here. All right, good boy. Good boy, Jackson. All right, ready to go. Let's see what's going on. Closed end fund Friday night. I guess the first thing we need to look at is the market. Anymore, Bitcoin's the market. It trades 24/7. So I've been thinking about it. I just don't think we're out of the woods yet. But I did just see something from Goldman Sachs that said we have another 15 to 20% to go also. So, I mean, I don't know. I hope I'm wrong, but it's just anyway. All right. Well, Goldman Sachs is talking about another 15 to 20% on the market, not on Bitcoin. All right, so Bitcoin it's basically flat for Bitcoin. It's down less than 1%, less than 1% up less than 1% or up more than up less than 1% or up less than 1% or down less than 1%, basically like unchanged for Bitcoin. All right, so let's get this show on the road. All right, so we have our daily factor show. Now, this is based on my own proprietary metric, the max factor. You guys have probably heard me describe it a million times, but I don't believe that conventional Wall Street has an effective way to measure these really high yield ETFs. No two total returns are created the same, and it's especially true on these ETFs that pay 50 and 100% annually. They just broke the metric. So anyway, let's get in the middle of this daily factor. Now, sure enough, the first one is a closed-end fund that pays 50. Where did this one come from? I mean, gosh darn it, a closed-end fund that pays 50%? You got to be kidding me. So I've already looked it up. SWZ, Total Return Fund, has been around forever. I mean, it came out in 1987, and it has, the 10-year history is not very good, down 12%. Anyway, but it's done all right lately. Let's look at the monthly here. And this got to be a yield trap, right? You can't pay 50%. I mean, anyway, that goes back to 2008. It's traded between basically between $3 and $9 since 2008. Got as high as $9 late 2018, 2019. Came crashing down after 2020 to about $4. Rallied to about $7 in 2022, took it down to $4. But nonetheless, they've been paying dividends this whole time. And according to my own graphic, well, on a trailing 12-month basis, they're paying 55% right now. Price has gone in the past 90 days from 605 to 595, so that's pretty dang stable. Anyway, all right, OCCI. What the heck is OCCI? OFS Credit Company. Okay, probably, I always say distressed loans or high interest loans, whatever. Terrible long-term record. Look at that. Look at all that red right there. That looks like my account looked this week. Everything is red. I mean, thank goodness for ULTY, or hang on a second. Am I sharing the screen? So you guys are seeing what I'm doing. Okay. I forgot to use the second monitor, but that's all right. We're used to that, right? You guys don't care about that. Anyway, I was wondering, it seemed weird. Okay, let me put the second monitor on. All right. So, okay, perfect. Sorry about that, guys. All right. So OCCI, I mean, 30% yield. Anyway, ECC has a 30% yield also. The NAV's been getting killed on both OCCI and ECC. Jackson, what are you doing over there? He's got a full tub of food, and he has food in his bowl, but he knocked the top off his tub, and he's just eating out of the tub directly. Jackson, just go eat out of your bowl. It's the same food, buddy. All right. BPI. Let's go see what BPI is. Sorry, on the closed-end Friday, that's what we put it on Friday night. I have no idea about closed-end funds. The only thing I know is the stuff that you guys have told me. So, and I'll respect your opinion. I got it, Chad. I'm on it now, though. I'm just dog-ass tired. You don't know how close I came to canceling. I had it ready to go at 7:30, but I just could not keep my eyes open. I ate 2 chili dogs, homemade chili dogs, good homemade chili dogs, cheese, everything, onions. Oh my gosh, good chili dogs. And I was just exhausted. I could not keep my eyes open. So I thought about canceling it altogether, but then I thought, well, let me just lay down for about an hour, see if I start to look a little bit better. Yeah, I hear you on the payout history there. I don't have the special distribution. I figured that. The max factor doesn't have the it's not really made for closed-end funds. I hear you on that. All right. Well, anyway, there's always an editor's choice to the max factor. I'll let you guys be the editors tonight, because sometimes even as good of a metric as the max factor is, doesn't tell you the full picture. So there'll be an editor's choice, and we aren't going to let something win that had a special dividend or something. I'm on top of it. But you guys can be the editors. I'll let you choose or we'll choose it together. I'll consult with you guys. All right. So what is this? BPI, Grayscale Bitcoin Premium Income. Okay, this is a legit one. There's nothing wrong with this one. I mean, this is definitely legit. It's just the Bitcoin's been getting murdered lately, so it's down, but that's whatever. All right. A Bitcoin closed-end fund. Looks like they're doing a long synthetic on. I love this. The same thing the Rex shares does. Same thing Yieldmax does. No need to ever buy stock. The people that say you have to have that the synthetic doesn't get it upside, or it's not true. This is all you need right here. You need a call and put at the same strike. Go out 3 months, 6 months, a year. Go out in further time frame, and then just go out in a shorter time frame and choose an out of the money call, and there you have it. And that's the perfect synthetic covered call structure. Tried and true. Hedge funds have been doing it for years. It doesn't make any difference if you don't have the stock, especially if it's a stock that doesn't pay a dividend. It is true if you do a synthetic, you don't get the dividend, although the dividend is priced into the price of the synthetic, though. But in any event, all right. So I like their strategy here. So let's go. So BPI is my early favorite because it's in an underlying that I know about, Bitcoin. It pays a reasonable yield, but still a high yield. Now, granted, though, the price is down on 90 days, but, we'll give them a break because Bitcoin's down. Jackson, what in the heck are you doing? Hang on. What are you doing, Jackson? I think he thought there wasn't enough food in the bowl, so he wanted to go supplement, and he knocked the top off the tub. Anyway, I put more food in his bowl. Man, Jackson. All right. But BPI is early favorite. Next, we have GGT. All right. GGT. Now, I've had an exhausting week for some reason. I've been working on a bunch of content. I just haven't got it out yet, but I've been staying up late working on content. Then I've been waking up in the middle of the night every night and checking Bitcoin futures and checking. Last night I was up half the night, and Thursday night, or I guess Wednesday night, I was also up. All right, this is the Gabelli Multimedia Trust. Okay, well, I like the sound of that. I know what multimedia is. I know what Gabelli is. All right, well. The distribution's high, but it's reasonably high, right? 25% isn't too high of a tax on the future upside. And the NAV's down, but it's not just getting crushed. It's off a little bit. Anyway, CCIF, probably closed-end fund. I used to know what that stands for. Closed-end income fund is what it stands for, or something like that. Carlisle. Oh, no, I remember. That's the same thing I thought last week, but it was Carlisle. And every time I think about Carlisle is like a Illuminati. These guys are Princeton. I mean, this is as blue blood as you get. This is private equity. These guys all live at the country club, out there in Greenwich, Connecticut. Carlisle this is the deal. This is as good as it gets. Anyway, they a lot of red on their past performance also. All right, well, we'll see. Okay, BCAT. What's BCAT? Maybe if I do this a couple more times, I'll actually get to know some of these funds or whatever. Okay, BlackRock. So I'm comfortable with that. BlackRock, Capital Allocation Term Trust. That sounds right up my alley. Just like the Gabelli Multimedia Trust. I can understand these. It pays a high yield, 24%. Looks like it pays monthly, but it's not so high. It should just crush everything else. Now, having said that, there's red all over the screen over here as well. And they never did take back their March high. And anyway, all right. That one's dead to me. That one's definitely not going to win the editor's choice. Okay, ECAT. Let's see what ECAT is. Yeah, Jackson is mad he didn't get any chili dog. Good point. Easy Life or Chad. Yeah, he doesn't. I don't really give him table scraps. I don't want him to die at a young age from a heart attack or whatever. So I try to. I mean, he already has a problem overeating, but I'm not big on giving him table scraps. It's just too rich for him. So what I'll do if I have a chili dog, I'll break off a little piece of bread that doesn't even have any chili on it and just hand him a little, just so he thinks he had something, or break off a little tiny piece of dog. And I may give him something just to pacify him, but yeah, I don't share table scraps with him. All right. Well, hey, Jackson, what are you doing? What are you doing? Anyway, I like the looks of that. Anything that pays between 20 and 30%, covered call fund, closed end fund, at least they have a chance. I mean, they have a chance. And look at this 3-year performance of 10%. I think that's annualized. So let's look at that. Maybe not. Maybe that means 10% for 3 years total. That's not very good. Let's put it on monthly and see. But it's 10% annualized. That's really good. It's about a market. No, it's so yeah. Well, 3 years would be, that's 25, 24, 20. Yeah. I mean, it went from 13 to 15. No, 10% overall. Okay. Well, at least I know what that metric is now. 10% overall. Okay. ECAT. So GOF. Let's look at GOF. Guggenheim Strategic Opportunity something. I like the sounds of this. I know who Guggenheim is. I know what a strategic opportunity is. It pays a decent yield. It recovered its March, recovered after the March lows. But look at this red right here. Wow. That's not that impressive, is it? All right. Well, okay. CLM. We all know about CLM. That's Cornerstone. We don't have to look at that, do we? CRF. I mean, those are solid as it gets. I mean, they both pay 18, and that's before factoring in the effect of the of dripping and NAV and the rights offering. It's before the rights offering, really. So if you're into these funds, you know all about the rights offering, you're probably doing better than that. So this is a baseline. This is like if you didn't know about it, you just bought it and forgot about it. So it's a baseline. Anyway, but here's what I like. Look at CLM. It is, well, this is something that's wrong, though. I had this problem on the spreadsheet a few weeks ago, and I cannot figure this. Never mind. I figured it out. But anyway, so we're down a little bit on the quarter, but up a little bit on the year, up 10% on the year. No, that's exactly what I can't figure out. My spreadsheet has some kind of ghost in it I cannot figure this out. It's saying it's up 10%, but it's down 10%. And I looked at it. It's not, the problem isn't on this. This is just the graphic from my main spreadsheet. I cannot figure out what the deal is with that. Anyway, CRF. CRF is paying about the same, and you want to talk about steady NAV. It's dropped a dime the past quarter, and it's dropped a little bit over the past year, but no big deal. All right, I just figured out what it is. This comes from a different data source. This I just need to quit showing this, or I need to start pulling it from the same data source. Anyway, these numbers are right. Well, we're going to go by these numbers, and the max factor pulls the numbers from these numbers right here. It doesn't. That's just for information only, and it's just pretend like you guys didn't see that. All right, RIV. What is RIV? River North Opportunities Fund. Okay. Let's see what's going on with these guys. Looks like they pay monthly. They barely recovered their March high. Red all over the screen. 13% yield. But a 13% yield when you're down 7% on the year is not that impressive. I mean, or at least not over that year. Doesn't mean it may not have been a good fund over a different period of time. But all right, that one's definitely not game editor's choice either. FAX, FAX. Fidelity Alternative Income or something. I don't know. Asia Pacific. I got the income right. It didn't say all. I figured the A might be alternative. Aberdeen Asia Pacific Income Fund. Wow. All right. Pays monthly. Pays a 13% yield. It's positive year to date. I mean, I don't know. All right. FSCO. This is this one that you guys like. I mean, it's getting killed on the quarter, down 17%. It's down more than it's given out in distributions. But I think I've heard that somebody likes this or something. FSCO. Credit Opportunity. It's not that these may not be good funds, but maybe in a environment where interest rates are going down, they don't perform. This as well. They become less valuable. It could be a good fund in a different market environment. 3-year performance of 44% is not bad. That's not too bad. All right. Let's see what else we have. YYY. We all know about YYY, but let's just put it up here anyway. Oh, this is a fund to funds. If I was going to do one of these, I would get Cornerstone because you guys say so, and because it checks out. It's not just because you guys say so, or I would get CEFS or YYY and just let the professionals do it. Pays 12%. So. Yeah, and so they have just different, they have some healthcare, some science and technology. They have they have their own, or not their own, they have the Aberdeen Total Dynamic Dividend Fund, AOD. They have that we just looked at ECAT, that ESG Capital Allocation Trust, Western Asset Diversified Income. Well, that's not doing well, is it? Look at that chart. That's a dog. Anyway. Now, this is the one we were talking about in the afternoon show that has the high expense ratio. Yeah, 3.25. But there's a caveat with that. I don't want to get into it now, but it's high, but it's not as high as it seems. All right. CFS, yeah, and Sirloin. Okay, Sirloin is not a closed-end fund, I don't think, but I must have thought it was when I was getting the show ready. We'll still look at it. I mean, because it's the type of fund that could be It could be a closed-end fund, I guess. They do have senior loan closed-end funds. This is actually an ETF, so we'll make this one ineligible. If this one wins, we'll make it ineligible. But at least I know how to evaluate these more because it has all the stuff where I'm used to seeing it. Has 6.7 billion. It pays 7.7 on a trailing 12-month basis. It's been around since 2013. Lots of red, but not big red numbers. Those are small numbers, so it looks like it's really safe. I always talk about funds that are unstable. I talk about funds that are maybe too safe and too stable. They're so safe and so stable, they don't grow your money very well, maybe. And this might be an example. But for an income fund, I mean, that's, it could be a good thing. All right. What else? Did I miss any? CEFS, that's from Saba. Did I do the ASGI? I don't remember if I did ASGI or not. Let me look really quick. But anyway, those are our competitors. These are our competitors. Aberdeen Global Infrastructure. If I did this, I don't remember. Well, I like that. That's the winner. Ding, 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 ding. We have a winner. We have a winner. I mean, I'm a frustrated growth investor. Income's fine, but I mean, growth's everything. All right. Well, that's impressive. And look at all this screen right here. That's probably an early. I'll let you guys do the editor's choice, or I'll let you guys put in your 2 cents. But that is an early favorite in the editor's choice award. So anyway, let's see what the numbers say though. We'll let the max factor do it still. So let's look at some other stuff we can look at. If we ranked it just by NAV return, ASGI is the only one that's positive. Okay. But if we ranked it, this 1 year total return's not right. So we aren't even going to look at that. Let's just go by the stable dex. This tells you the relative stability of these funds, and it compares them to the S&P. One is the S&P. So like this one, BPI, that's 33. What is that? I already forgot what it was. That was a Bitcoin trust. Anyway, it's a third as stable as the market, or 3 times as crazy as the market. Meaning if the market's up 1%, you'd expect this one to be up or down 3%. All right. OCCI, FSCO, GOF, also not very stable. Let's go to the most stable ones. Now, then we have sirloin. Yeah, remember I told you there's funds can be too stable, and that sirloin's an example of that. Although for an income investor, too stable is a good thing. Could be a good thing. But the problem with too stable is you get your income, but you don't have any chance for growth. And growth is, but so it depends on what your needs are. Anyway, so let's look at the ones that are stable as the market or more so. So CRF, CLM are market stability, ASGI, market stability, BCAT, FACS, RIV, SWZ. I like the looks of this SWZ also. I'm thinking SWZ is also a favorite for the editor's choice. All right, so let's see what you guys are doing. I want to make sure you guys are behaving yourselves. I put the thing where it's not so obvious where I'm looking off to the side. Yeah, ASGI. ASGI is impressive, Dylan. I mean, you gotta say it's impressive. A good site to review closed-end fund is CEF Connect. Yeah, thank you. I'll check that out. Maybe next time, instead of going to FinViz, we'll go to this. I'll make the show better next time. I'm just not feeling that well today. I just mainly go to FinViz to see what the name of it is. And I just kind of like to get a look at the chart also. And it's probably not the best way to judge an income opportunity, but anyway, yeah, we'll try to make this show better. We'll try to make this show better. Yeah. And you have to look at the payout history. I definitely missed the boat on that one. I knew that when they had that kind of yield, it was something that I even joked. It's probably a yield trap or something. Anyway. All right, so let's just run this, and then we can shoot the breeze for a little bit if you guys want. You guys probably want to go hit the club, and I'm sympathetic to that. I need to rearrange the screen where it's in the same shape as it is on my desk, so it makes it easier to find the mouse. All right. All right, so sustainability is the new max factor. They're the same. It's just I repackaged it. Just max factor and sustainability are the same thing. So, I mean, because that's what we all want. We want sustainability. We want high yield, but we want sustainability. Okay, ASGI, heck yes. Heck yes. All right. Well, if you guys have another one, that one may be the worst one. It may have just had a good quarter. If you want to do a write-in vote on the editors, I'll listen to write-in votes. I mean, CLM. I mean, you can make a good case also for. You could also make a good case, I think, for this. Well, no, I don't know. This SWZ, that's the one with the special. That's the one we don't want to make a good case for. It had a one-time special dividend. I think we know who the winner is. We'll give an honorable mention to the we'll give runner-up status to YYY and also to Cornerstone. Yeah, so this one, had one giant dividend right here. Usually it's in December, but it could also be at the end of the fiscal year end or for whatever reason. But they paid 4.7 cents there. That's the special dividend right there. No, this is the $3 right there. Yeah, so it's not really an income fund. I mean, because you know what, that's not an income fund. So, all right, so SWZ is prohibited from future competition. Anyway, at least I'm starting to know these. I mean, ASGI legit looked good. I like the way that BPI looked also, or just it's. I mean, it's just because its underline is getting killed. I think that one, given other circumstances, could probably be a decent looking fund. But yeah, this ASGI. So let's drill down on ASGI a little bit. That is a good looking fund. I guess we could go to CEF Connect, but I don't have an account there, nor I don't even have a login, so we'll just stick with this for today. But I need to get a login over there at CEF Connect. And I need to curate this list a little bit, or I'll tell you the way I got the list. BR from my Discord, and you guys know him as Brad. He's in the comments all the time. I don't see him tonight. He gave me a spreadsheet from one of some Discord that they're in, and it had like 100 closed-end funds. Great spreadsheet. I went through there and I sorted by highest yield, and I just pulled out the highest yield. I got like 10 of them with the highest yield because I didn't know what any of them were. So that's how I got some in here that are real dogs. But anyway, this ASGI, this was, I mean, it's 11%, and you get decent, positive, stable NAV. 5-year return of 16% is pretty weak. But it could work for an income fund, and I like how it just has a general up and to the right. Let's see what the most recent news is. Dividend investor making $16,300 a month shares his top 7 high yield stocks. Don't let anyone tell you dividend investors will not pay, or dividend income will not pay the bills. Yeah, that's a good one. Aberdeen Investments, U.S. closed-end fund announces distribution payment details. Oh, this is just their little deal. All right, well, looks like Aberdeen may be the round hill or curve or whatever of closed-end funds, or maybe curve is the Aberdeen of covered call funds. All right, what are you guys doing? Okay, CEF have fixed number of shares, market price not tied to NAV. Yeah, exactly. So that's why it's such a big deal when you can drip at NAV or when there's a rights offering. I get that. So really now that, I mean, I say I get it, but do I really get it? Because to put them in the max factor is treating them like they're an ETF. So it's not at all a fair comparison. I mean, I probably need to make a different metric for these or something. I'll learn more about them or whatever. My main thing was I just wanted to be able to see, hey, is CLM, what's better? Would you be better off getting CLM or triple QI? Or would you be better getting CRF or Tesla? Just joking. You'd be better off with CRF. But you know what I mean? But I wanted to have like a baseline with some big ones. YYY, CEFS, CLM, CRF. I think that's fair to compare those. but yeah, because it trades at I guess to make the max factor more realistic for closed-end funds, I would have to maybe take an average of the discount or premium it's trading to NAV, and I'd have to factor that in, and yeah. Anyway, this is just for fun. You guys know that. I got you. Okay, well, heck. Okay, well, that's fine. Well, I didn't know. You never know what you're getting into. Come on, guys. What is going on? I need to rearrange these darn monitors. There it is. Brought to you by Nuveen. I'm sure I could study this and learn, and learn to make a better metric. But my goal was to make a good metric for the covered call funds. That judges the sustainability of the covered call funds, and I really think the max factor does a pretty good job. But yeah, I'm not doing a great job covering these closed-end funds. So it does want me to put in some stuff here. But let's just go to Fund Screener. Yeah, you're right, but you can use it without doing it. Look, they want to show me around. They're probably going to try to sell me something. I'll just close it. All right, start new search. Are you sure you want to know? Gosh darn it. I just want to look at ASGI. This looks like it looks very similar to Seeking Alpha, or something very professional. I like this. Now, what do you compare closed-end funds with? Oh, you compare it with the NAV to the price, because that shows you the premium or the discount. Okay. But the closed-end funds have a benchmark that, in ETFs, you can benchmark anything to either the SPY or the bonds, depending on what it is. Fund basics. Yeah. This is what we'll do next time. The fund's investment objective is to provide a high level of total return with an emphasis on current income. There's no assurance the fund will achieve its investment objective. The investment objective is not fundamental and may be changed by the board of trustees without shareholder approval. The fund seeks to achieve investment objective by investing in a portfolio of income-producing products, private infrastructure equity investments around the world. Under normal circumstances, at least 80% of the fund's net assets will be invested in U.S. and non-U.S. Well, it does say infrastructure, but I mean that's pretty broad. That's a pretty broad deal. But yeah, you can see the AUM or debt. And yeah, this is cool. Okay, well, next time we'll do a better job, and I bet I can even do a search in here. I bet I can do compare somewhere, and we could run them against each other. Yeah, that's good advice. All right. What do you guys want to talk about? I'm still out tired. I'm going to try to make an excuse to get out of here early. But if you guys want to talk about something, put it up here. I'll talk about anything, but I'm tired. Yeah, we've already covered that. The special distribution. Fool me once, shame on me. Fool me twice, never going to fool me again. Or what is that? Remember when George Bush said that? That guy, he said some hysterical stuff. Fool me once, shame on you. Fool me twice, never going to fool me again. All right, we got the second monitor situation worked out. All right, but I want to read you guys' comments. FSCO, NAV is held stable while price dropped, unique to closed-end funds. Oh, and it's at a discount right now. Yeah. That's what I'm saying. For me, I'm just gonna buy if I ever want a closed-end fund, I'll just get a closed-end fund of funds and let those guys, because that's what they do. I'll let their traders worry about it. In fact, let's go see that. The one I'm leaning towards would be YYY, just because I like this ticker. So let's go see what's in YYY. But let's look here. I do like how FinViz shows you the top 10 holdings, but I guess this will do it too. So wait, YYY, is YYY not there? YYY, is YYY not there? Is YYY not a closed-end? I mean, maybe they don't do fund-to-funds. CEFS isn't there either. Well, let's do like CLM. Okay. Maybe they don't cover fund-to-funds or something. But this is a good resource because I've always wondered, what does CLM really have? What are they really doing? I think they do some covered calls, and they do some other stuff, but yeah, okay. So this is CRF. You got distributions, pricing, portfolio characteristics. Okay, this is their top 10. Okay, NVIDIA, Apple, Microsoft, Blue Chip Tech. I like that. Eli Lilly, Broadcom, JP Morgan Chase, credit quality. Yeah, this is a really good. You can get the yield to maturity. You can get the country breakdown right here. Yeah, this is a really good source. I won't use FinViz anymore for closing funds unless I just want it. But FinViz still does have that chart. I do like to look at that chart though. But yeah, for serious deep dives, because we could go fund screener probably, and I'd like to look at, okay, start new. All right, start new search. But I don't want to clear the default choices. View last search maybe. Oh, I see. You have to choose one of these. Okay, so equity. Oh, I see. Okay, covered call fund. Here we go. This is my area. Equity covered call funds. That's perfect. U.S. equity too, whatever. So now, then what happens? Now what do we do? Do I have to choose other stuff too? Or, oh, I guess view funds. It shows me which ones qualify. Okay. All right, here we have it. So this is the way I need to start putting them in the max factor, is find the ones I'm interested in, screen for them, make sure they don't have a special dividend, and then, yeah, CLM and CRF, of course, they do cover some covered calls in there. Eaton Vance, yeah, tax managed by right income. This is really cool. Neuberger Berman, or Nuveen. Nuveen does a covered call fund that we cover called XXXZ, right? No, I just talked about the other day. It's a dynamic override. It may be that one though. Here, let me look. Now I'm going to have to go back to FinViz also because I'm more comfortable in FinViz. Nuveen dynamic override. Okay. So this is actually an ETF though, or is this a closed-end? No, it's a closed-end fund. I didn't realize that. Well, this has been on the max factor for a long time. This triple QX, and this is an old one too. It's been around since 2014. Well, I talked about this one. We did this one the other night, last night on NASDAQ night. All right. Well, that's cool. I'll learn, guys. I'll learn. Oh, well, you got Greg in the house, Greg and Tina. And I don't think I've ever seen you around here before, but I appreciate you being here. Yeah, from now on is CEF Connect. That's all I will use. Imagine if closed-end funds pay weekly. That's not a thing, is it? Surely that's not going to become a thing. I mean, maybe, but I mean, all right. So you mentioned these are closed-end funds. What are closed-end funds? Simple terms is fine. One of you guys take that? I bet you guys already answered that. Oh, that's why you were saying this. Okay, yeah. Um, yeah, so a closed-end, so in an here's the way I understand it. And I understand ETFs. So I'm going to compare it to an ETF. I don't really understand closed-end funds to the degree I need to, but in an ETF, if you it's like an investment company. They put together a pool of money and they invest in a strategy or whatever. But so let's say three of us invest in an investment company. Well, then a fourth guy wants in. Well, in real life, if we were just doing them three buddies, one of us would have to sell them, would have to sell them shares or whatever. We'd have to re-divvy it up. But in an ETF, we don't. The ETF will just print more shares. It's like a constant IPO. And a closed-end fund, they don't print any more shares. It's they probably can, but they probably have to do like stock does, where they have to file for it and get approved and stuff. So yeah, and so what Z Bikerman says is but because of that, it makes their shares valuable, and that's why some of them, the good ones, will trade at a premium. People are willing to pay up to get in on the partnership. Where in an ETF, they just will print more shares. But by the same token, if a bunch of people want out, it's not like the people that are in lose money having to cash the other people out, because the ETF will just destroy their shares and give them their money back. So I really like the structure of an ETF, but it gives the ETF. ETFs don't really trade on supply and demand, not really. Closed-end funds are more like a stock. So that's the way I understand it. Closed-end fund won't be forced to sell at a bad time. Yeah, good point. That's a good point. That's a good point. That's the other side of the ETF, because if everyone wants out and the ETF has a position in something, the ETF, they'll let people get out and the brokers will just destroy the shares, but the ETF will have to come up with the money to give the brokers to give to people. Yeah. But so the way I understand it, an ETF can't have a short squeeze really, because if everyone wants in, they'll just print more shares. But I think these funds are like closed-end funds, like more like stock or a company. It's more like a company. Anyway, you like that if they are printing us money, we are buying it up. Seems like, yeah. I see this. I've seen Tasty Trade this morning mention your stock, LLY. Yeah, well, not my stock anymore. Used to be at one time, but no. But my family still has shares in it. My sister still has her shares. All right, type in a CEF symbol. Oh yeah, I got you, Greg. I got you. I think that's good to look at though. Why is it ETF? Okay, why did I think it's a closed-end? It's an ETF that's a fund of closed-end funds, right? Okay, let's look here. I'll get better at looking at those while at the same time I'm doing my show, because I'll get better so I can react more real time. But at least now you guys don't have to see what's that movie called? Somebody was saying I look like Inception or something, the picture within the picture or something. All right. So yeah, YYY is ETF. But let's see what's in it. Are these closed-end funds in it? For some reason, I thought it was a closed-end fund. But yeah, it has some closed-end funds in it. AOD is a closed-end fund. Okay, I got you. It's an ETF that's a fund of funds. Okay, well, this is right up my alley then. Something like this is right up my alley. I don't like how they haven't shown a lot of growth, and they dropped from 12 to 10 when the market pulled back. That's like 18%. That's about as much as the market pulled back. So it looks to me like you're taking market risk and not getting market rewards. You do get a 12% yield though. But in any event, all right, well, yeah, good advice, guys. Great advice. All right. Chart with the percentage helps visualize it. That's good advice. I'll do that next time. Greg and Tina, I appreciate you guys for being. I just thought maybe I had to sign in to even use it or whatever, but yeah. Do you think a closed-end fund will ever pay weekly? I guess you could do one. something like YYY could come out and invest in closed-end funds and then just break the payments off weekly. I don't think YYY does pay weekly, but maybe that's the deal sometime. Maybe that is a deal. I'm just going to go from the bottom here. Yeah, YYY is the 3.25 expense ratio. You're like, why did I buy this dog? Hey, RJ's here tonight. CEFs are set amount unless they have the right. Oh, unless they have the rights. That's the whole thing too, and that's why the rights offering is so important. Now it's all coming together now. So when a stock goes public and you have an IPO, there's a limited number of shares. That's all there can be. But then the stock they can file, and they have to get approval to release more shares or whatever. But I think a closed-end fund is more like a stock in a lot of respects. Dylan, what are you talking about here? You've learned a good bit in the last few days. Buffer funds yesterday and closed-end funds today. Well, the guys in here are teaching you about closed. I've done nothing but butcher everything in here. But yes, I know a thing or two about buffer funds, and buffer funds are fascinating to me. And I'm glad we got off on that tangent last night, because I wanted to show you guys that. Here, I'm going to show it again. I'm going to show it really quick again. There's this fund called T-Jewel has always amazed me. It came out last July. It came out last July, and this thing is amazing. Let me show it several ways, but this is the one I was talking about last night. In case I wasn't there last night, it's from Innovator, Equity Defined Protection. And if you keep this fund, it started in July of 2025. So you could buy it then, and you hold it to July of 2027. You're invested in the stock market, the S&P, but you can't lose money. You cannot lose money because they use puts. Now you can't make all that much either. They basically turn it into like a bond or something. That looks like a good chart, but it's not making anything. It's barely. It's up 5% year to date. But you cannot lose money. It doesn't matter if the market goes to zero. If you hold it till that term, you'll be out of it with your money back. And look how they do it. I was just talking about how much I like the synthetic structure. That's all they're doing is they're using they aren't really using a synthetic, but they're buying a SPY option at a strike price of 11. The SPY trades at like 660 or something, 650, right? Something like that. So, when you have a strike price of 11, it's basically stock. So that represents stock. That makes or loses 1-to-1 with stock. And then in addition to that, they have they're selling a call and buying a put. Well, okay. Then in addition to that, so they have exposure to the market through the deep in the money. Then they go out of the money and they write a 701 strike. And there's not really a 701 strike, but they're flex options. So they go out of the money and write 701. So they're capped at 701. If the SPY goes above 701, that's as much as they can make. But they take the proceeds from that 701 and they buy in at the money put. So when they initiated this fund, the SPY was probably at 617. And that locks out any chance of downside, but the put doesn't bleed. Or it does bleed, but they paid for it with the call. So they've capped their upside to a certain point. But what it gives you is if the market goes up, they're going to be capped at 701, but it just gives you kind of a slow and steady, kind of almost like a T-bill or something. So let's look at this. But yeah, I love defined equity or defined outcome funds, buffer funds. So let's look at T-Jewel compared to the SPY. Yeah, T-Jewel looks like a bond. I really like this thing called T-Oak. That's basically a bond. It uses options, but it's like a T-bill. And T-Jewel looks just like T-Oak. Now, T-Oak's even more steady. T-Jule's not totally like a bond, but see, so T-Jule lost a little bit of money when the market pulled back, but at the end of the term, no matter, even if the market was down 50%, your investment would be worth $10,000. But T-Jule can make money, just not more than 7% over the next whatever time that is. Let's go back and look at that. See, I managed to change the subject from closed-end funds to something I know about. So that's the thing. They go out all the way till the time it expires, July of 2027, 2 years from now, and they wrote the 701 option. So no matter how high the SPY goes, the most they can make is the difference between 617, which is where the put is, and 701. So over 2 years' time, that's like 10% over two. Anyway, so that's the thing. They can't make very much money, but they can't lose. They really can't lose any money. Now, the net asset value will still go up and down a little bit, but I mean, come on, this would be great if you're on margin or whatever. Or I mean, margin might be a use because this would be super safe to hold. You wouldn't have to worry about a market pullback knocking you out of your margin position, because this went from 28 to 26 in the April crash, and really like 26 and a half. So it dropped $1.50. I mean, it dropped like 4 or 5%. Those are cool. I'm glad you learned something. I like to switch it, change it, and talk about options. You found out today was a 10% year. Oh yeah, BNOV, same concept. So they have ones that they have different ones. They have some that last a year. They have some that last 6 months. But whatever the case is, they go out till the end of the term, and first of all, they buy a put that set the money. That locks out any downside. And then they go out as far as they can to offset whatever that put cost. And depending on how much premium, and depending on how the options are priced, they can go out different amounts, but they go out as far as they can. And then it's a caller. It's the same strategy that ULTY does. ULTY does a caller. These are caller funds. ULTY does it in a different way, but I mean, they're selling calls to buy puts. The difference is, real quick, ULTY, they sell calls to buy puts, but they don't try to lock out all their downside because they want to pay a yield. So they'll sell calls and they might spend about a third of the money on puts, but they'll want to pay you most of the money, So, but these don't have to pay you because they're just growth funds. They aren't income funds. So they'll just make it even out. All right, Max, talk about what? SGov. Yeah, okay, it does. And that's why I compared T-Jule. Let's look at BNOV now, because it's like BNOV is probably the one that just came, because every month there's a new one. So let's look at BNOV. Innovator, U.S. equity buffer. Seriously, these are probably, if you put the pencil to it, even though you can't lose money, you cost yourself so much upside that they're probably sucker bets. I mean, but wonder if you retire and you think they always talk about, wonder if you retire, and there's people that retired in 2000. The market went nowhere from 2000 to 2009, and that's called a lost decade. And so let's say you retire, but you aren't like wealthy, you have maybe barely enough to retire, but you may be trying to take retirement early, but you just can't take a chance on retiring. And then maybe the first year you retire, the market drops 30% or something. That'd be just your luck. This is the use case for those, because if you have enough money to retire, but maybe barely enough, you can put it into something like this. You get a little bit of growth, but you don't have to worry about the market wiping out your retirement. So yeah, this is BNOV. It looks like, look at it. So BNOV is up 9% for the year and 40% for 3. Now I think it used to be something else. There's no way. Let's look at that. I bet BNOV was a symbol that belonged to something. Oh no. Wait. Is BNOV simplified? No, there it is. because there's no way it's up 45% with this structure. This just came out. BNOV used to be something else or something. And they can go down. So this one just came public a few days ago, probably November 1st. So the NAV can go down because since November 1st, the market's down 7% or whatever. And the NAV can go down, but if you hold it till the end of the time, you'll get your money back. So I'm trying to see here how much it's down. Oh yeah, it's down like 2%. You can see it right there. Oh, and also, this isn't, here's the other deal. This isn't one where you can't lose anything. On this one, they make it where you can only lose 9%. That's pretty reasonable. So what they'll do is they'll go buy a put that's 9% out of the money for 2 years from now. And then they'll see how much that put cost. And then they'll go out of the money as far as they can to make up the cost of that put. And right here, this one gets 17% upside. Here's your trade-off on this one. You get 17% upside, but the most you can lose is 9% on the downside. So, whereas the last one, T-Jewel we looked at, you could only make like 7% total that's over 2 years. That's like 3% a year, basically like a bond. Yeah. But this one, they have all different sizes of buffer. Yeah. This one would make a lot of sense if you retired, or let's say you're on margin and you retired, but you aren't super wealthy. You just cannot afford to, and maybe you're paranoid the market's in a bubble and going to crash. Something like BNOV could get you through the first couple of years of retirement. It could get you by. Maybe there's a global recession coming up or something, But this would be a terrible idea for young people because young people need the growth and you have time for you to earn it back. And also when you're young, you're contributing every week to your 401k. The people that were working in 2008 and 2009, well, lots of those people are retired boomers right now, but they made bank because they were contributing to the 401k on the way down, and then the market recovered, and but these are good for somebody that's not making any additional money and has to hang on to what they have. But thanks for bringing that BNOV up. That's a good one. Okay, now SGov. I'm sorry, I changed the subject again because you want me to talk about bonds, and anyway. But yeah, let's look at SGov real quick. What is going on with this? I put them side by side, so there it is. Okay. But yeah, I compared T-Jewel to T-Oak, but let's compare BNOV to something like SGov. So yeah, SGov is short-term bonds. Those are just all but guaranteed. Those are all but guaranteed. Let me compare T-Jewel to SGov. T-Jewel and SGov are very close to each other. But SGov is just, let's look at SGov really quick. We were talking about BNDI. Remember the NEOS ones after work? And we were talking about some other ones. But we should have, CashI is another one, KSHI. That's NEOS. I'm surprised that one didn't come up. That's the same kind of fund as SGov is. Anyway, I'll stick on the question though, but SGov, CashI, 0 to 3 month treasury bills or treasury bond. Okay. Oh, yeah, that's right. They're bonds. Well, I thought it was a bill. Look at that chart because this is NAV depletion. They make money and then every month they pay out what they make. And then they make money, but it's just so steady because it's guaranteed. It's just a T-bill. So it goes from 100 to 168, and then watch, it pays a 68% or 68 cent dividend. Watch. or well, 34 cents, but whatever. That should be the difference between these two prices. It's, I'm sorry, it starts at 100.34. Okay. And it goes to 100 point. Yeah, it goes up 30 cents. Then it pays 30 cents. Then it goes up 30 cents. The reason it just goes straight up like that is because the market makers know these are T-bills. They know they're guaranteed. They can't lose, but the equity has to adjust. They have to adjust the price. So if you buy it later in the month, they just have to make a fair price. But yeah, it goes up. It goes up about a penny a day. Then that's another way to think of it. It goes up a penny a day. Then you get a 30-cent dividend. And you can see it does make a little bit of capital appreciation, because right here it was in December, it was like at $1.33. And then back here, it's like at $1.40, but it just makes just a little bit. Year-to-date performance, or look at this, 5-year performance is 0.5%. That's just straight flat sideways. The dividend yield is 4.2%. 4.2%, I think, is what the 20-year pays, or close to it. But let's say I would get, if I wanted one of those, just I don't like iShares. I mean, because it's a big Wall Street. I like the Option Bros. So Cashy, that's Neos. Let's look out and see how this one compares. This pays 5.21%, but unlike the other one, it is possible for this one to lose money. Not very much. I mean, it lost like 60 cents in the April pullback. So, I mean, this one has a little bit more. Whatever they're doing with this one, they take a little bit more risk. But you can see the same basic pattern. They go from a price of like $49.46 to like $49.88. So what's the difference is about 35 cents. And I bet that's the dividend. Well, 21 cents, whatever. The difference is the dividend. But yeah, there's lots of these. There's also, we were talking about Bondi after work. Now, these are longer term, so this shouldn't be as stable. This should probably vary a little bit more. But ones like SGov and Cashy are just short-term T-bills where you just it's just, you're basically guaranteed money. But see, these ones where you take a little bit more risk, instead of getting 4%, you get 5.6%. But your NAV can go up or down a little bit more. Yeah, that's a good one. Thanks for bringing that up. All right, you like cows? TGIL is it trades like a bond or a bill, but yeah, basically it is kind of like because you can make 7% in 2 years. So that's like 3.5% a year. So that's about what a T-bill pays. Yeah. And you can't lose, you can't, just like you can't lose in a bond. If you hold it till expiration, it's guaranteed. It's the same concept. They've just turned stock into a bond. I think TGIL is probably too conservative. And I'm not recommending it for anybody, or I wouldn't use it. I would use one like BNOV. I might use it because you could afford to take a 10% loss. But if you're new in retirement, you definitely don't want to take a 30% loss or something, but BNOV is a, 9% barrier, but you still get some chance at some upside too. Heck yeah. SGov sounds better than holding. Oh, it's way better than holding cash, because cash, cash gets hurt by inflation. But inflation is like 3% and SGov was paying like 4%. So you're barely ahead using SGov too, but you're still ahead. But yeah, that's the whole idea. If you can never hold cash because of inflation. So you have HCal, that's cool. SGov is super safe, pays a small monthly dividend. Well, yeah, okay. I love STRC. EW, I don't know if I've seen you around here before, but thanks for being here. Heck, I love STRC. So that's a preferred stock, but that's also you could compare that in a lot of respects to something like a T-bill or something. I don't know if it has enough data to go back here, but let's just go STRC versus SGov here. STRC, well, it doesn't look stable compared to SGov, but I mean, it was up 8% at the most. And well, it's only been out since September. So I love STRC. I just don't fully understand how they're doing it. I mean, I've read the prospectus and stuff, but yeah, it's the strategy preferred 9%. Okay. Yeah. No, in fact, we, as you guys know this, I think you guys know this, on MicroStrategies night, on Misty night, STRC always wins. That out of all the Bitcoin, high yield opportunities there's not a better one out there than Stretch. Stretch is killing it. And it's 10.95. Now, I think that can vary though. But their goal is to keep the NAV steady. And then there's Strike, Strive, Stride, and Stretch. Yeah, Stretch is the one that usually wins. But yeah, I follow all those, RJ, on they're all in the Max Factor. Every one of those is on the Max Factor, and they're part of Mr. Monday. It's really not fair to compare them to Mr. or to Misty and MSTW probably, but still, I don't really have anywhere else to put them, so I put them on Mr. Monday. But STRC wins every time. Yeah, those are the four preferred classes right there: Strike, Stride, Stretch, and they all have different strike prices and different things that they have to do. I mean, preferred, different deals you have to cut. I gave you guys that link to that Mike Coe thing. He has a podcast, and he was talking about all the different classes of preferreds, and he was talking about how they convert and when they convert and how to figure out how it's going to affect MicroStrategies and stuff. All right. So approximately 87 cents per share monthly for Stretch. Yeah. But the catch on that one is, though, it's not guaranteed, and the board can cut it if they need to protect the NAV of Stretch. From what I understand, they can even cut it to zero, or I don't know if they'll do that, but they can, if they need to, they can chop it really low. But as long as MicroStrategies, it's like a huge buffer fund or whatever, because as long as MicroStrategies just doesn't totally dump, that's all but guaranteed. Also, it's basically turning MicroStrategy stock into a bond of sorts. But yeah, I'm a big believer in Stretch. I'm a big believer in Stretch. Let's look at here. I think it has like $1 billion under management, but these things, they aren't ETFs. They issue shares like stocks. I mean, they're preferred stocks. And this was either $1 billion or $2 billion that was issued. I think par is 100, meaning I think it was issued at 100 or maybe 90. But they try to keep it on that price. It's also, isn't it supposed to be like they're trying to do it's supposed to imitate a stable coin or something? But yeah, look at this performance year to date, 7%. So you've got some NAV upside, and it's paid 3% in about a third of a year. So at that rate, yeah, 9-10%, whatever. Yeah, no, that's a good one. That's a good one. It pays monthly, and 80 cents, 83 cents, 85 cents, 87 cents. Yeah. Yeah, that's a good one. That'll be on Monday. All right, let's check out Bitcoin futures. Let's get a shorter term chart here, but sometimes sometimes the Bitcoin will rally over the weekend, and maybe it'll rally enough over the weekend that it'll take back a lot of the technical damage that's been done. And then the indexes will gap up Monday, and maybe the lows in for the indexes or whatever. I just have kind of a bad feeling that it may not be, but I mean, remember, this isn't financial advice. Check with the certified financial planner who knows your own situation. But I just look at stuff from a technical perspective too. A trend following or whatever. I mean, I'll change my mind really quick as soon as we start trending up, or maybe not as soon as we start trending up, but as soon as we set a couple of higher lows and higher highs, and maybe have some pullbacks where we pull back into support and there's buyers there, it'll start to feel like it'll start to feel like it's over. Just as far as the Bitcoin part of it goes, it just doesn't feel like it's over yet. But anyway, so here's our goals for the weekend. If the weekend guys come in and buy it, the whales come in and buy it, and it opens like at 90,000 or something, 91,000, that'd be awesome. then that might be enough to undo a lot of this damage. The indexes would be up, and then maybe the lows are in. I just think I'd be more convinced if we had just a big rally this weekend that took out a lot of these short positions. All right, so RJ, strategy's 8% professionally. Yeah, that's strike. So strike is 8%. Strife is 10%. And stride, well, no, okay. 9% is stretch, and stride is perpetual. Well, perpetual preferred. They just all have different, from what I understand, they all have different clauses, different things they have to do. They call it they have different priority in the, what's it called, a cap table, or they're some of them have priority in a liquidation, and some of them are at the bottom line in liquidate. They just all have different things they have to do. But it's a smorgasbord. Take your pick. If you're a believer in Michael Saylor, just get some of each. But I'm just saying stretch looks to me like what a lot of people want these covered call funds to do, me included. Everyone wants these covered call funds that'll pay, that could pay 15, 20, 25% and not have any chance of the NAV going down. And that's what stretch, I think they're trying to create that. They're trying to create a stable NAV at all cost, and yeah, that junior lean, exactly. You guys know what I'm talking about, because they're convertible to stock. When I say they have different requirements, exactly. They convert at different levels. They have different strike prices, and then they have different, and then some of them have senior status or whatever. They're different on the, so that right there is what makes them trade different, because based on where they convert at, and that's what Mike Coe was talking about on that link I showed you. But based on where they trade at and where they have to go, where they convert at, you can look at these and you can figure out you can also figure out how it affects MicroStrategy stock. Because the thing is, MicroStrategies used to just be a pure leveraged Bitcoin bet before these came out. And now I'm just going off what Mike Coe said. But now that these came out, Saylor has traded some of his stock. Now it diluted a little, whatever, for some of these preferreds. But the preferreds raised money, and they gave Saylor more money to buy Bitcoin with. So, I mean, never bet against Saylor. That's all I know. You never want to bet against Saylor. Hard sometimes see the Sunday run up for a Monday crash due to low volume. I went from 94 average on Monday down to 88 average now. I'll be probably, yeah. Well, I'm just wishful thinking. Does anyone here bet on the junior precious metals miner? Risky, but payoffs are high. The only thing I know about junior miners let's look at it here. I mean, is SLJ, is there junior gold miners too? SLJ is junior silver miners. And SLJY is the Amplify Covered Call Fund that plays the junior miners. I don't know if that's what you're talking. I don't know if you're talking covered calls or just junior miners in general. But miners are also a leveraged play on commodities, right? I mean, GDXY is like levered gold. It gets more upside than gold does, is the way I understand it, but it also has more risk. But this fund right here from Amplify, September, October, has this been out a quarter yet? No. Oh, yeah, this one's been out a quarter. I need to put this one in the max factor. We usually I think we do precious metals on Sundays. Tomorrow, we're going to do SPY Saturday. We're going to compare all the SPX funds. But on Sunday, we'll do precious metals. We'll compare Goldie and, whatever, all the precious metals one, SLJY. Yeah, junior miners. There's a junior gold miners too. It's GDXJ or GDJ or something, right? There's just not a covered call fund version of it. Yeah, GDXJ, the Van Eck Junior Gold Miners. All right. I bet there'll be a covered call fund out soon. I mean, they're making covered call funds on everything else. I'm surprised they don't have one here yet. Man, this thing's incredible. Because, like I say, the junior miners are probably like double leveraged. Or, I mean, they aren't really leveraged, but in essence, they are. But look at this performance year to date, 119%. I want to compare GDX to GDXJ. And that's right. Well, what is that? That's for a year, man. That's right. Well, I'm sorry. Of course it is. Well, no, that they should be different, right? Those are senior miners and junior miners. It almost looked like they're the same stock, but they definitely aren't. But look at 109% versus 108%. Okay, so let's go a level deeper here. Forgetting about the covered call funds, just looking at the underlines. I want to look at what GDX has in it and then look what GDXJ has in it. It looks to me like they're the same risk and same reward. I mean, or they have been over the past year. Okay, so this has Barrick Mining, all that Newmont, I mean, all the kind of standard ones you always hear about. Pan American Silver Corporation, I mean, yeah. AEM, Newmont. Okay. So now let's look at GDXJ and see what they have in there. They have Pan American Silver. I guess they're just smaller companies, but they're performing right about at the same. Yeah, they're smaller companies. It looks like Pan Am Silver is the only one they have in common. Do you have some of that? Do you like those junior miners? Or yeah, junior gold. Is that who asked the question? EWC. Risky, but payoffs are high when you pick right. Heck yeah. Heck yeah. Junior gold. I found it. All right. You love seeing me interact with others and trying to responding to everyone. Can tell you're not AI. Yeah. I'm barely. I think I may be coming down with something or saying I cleaned the house today. I always clean the house every Friday, and I broke out in a sweat like I was breaking a fever. And anyway, I took 2 aspirin. I took a hot shower. Then I started to feel better. But I think I've just been staying up too late and getting up too early. And I think I just need to take a day off tomorrow. I mean, I'll still do some content, but doing the 2 daily live streams a day, because the morning live stream actually takes about an hour to get ready for. Even all the AI I use and stuff, there's a lot of manual stuff I have to download and stuff. So anyway, but just not having the live stream. So tomorrow I'm going to have the top 20 list, but that's a pre-recorded show. And then sometimes I'll do it. Sometimes I might do one live stream. Maybe we'll have a Saturday night live stream tomorrow night, but I don't have to do the 9 o'clock when the market opens and then 5 o'clock when the market closes. And then, the daily factor. So I'm going to just get some rest tomorrow. All right. EWC says, if you own these, do your own due diligence as always. Okay. BTG, EQX. Oh, and you aren't talking a fund of funds. You're talking just going out and buying the junior miners themselves. You know me, I like to hit the simple. I have to oversimplify everything. I'm always thinking, well, just get a fund of funds that does it for you. But no, I got you. Some people really like to do their own research and are really good at it. But yeah, those are some good recommendations. I'm sure. Do your own due diligence. I'll put them up there so other people can copy them. And then we have, SGDJ is the Sprott Junior Gold Miners ETF. All right. Well, let's SGDJ. All right. bet you that I wonder if they have some of those funds that EW is mentioning, some of the stocks, I should say. Man, that's a good looking chart. That is a good looking chart. And this is an ETF, just making sure. 121%. Seabridge. Let's see. EW didn't mention SA. But it looks like they have some private ones because they don't even go, because they don't have a link that connects them to, or maybe they could be they may not be totally private. Maybe they're traded on other exchanges elsewhere. And then we have McEwen, MUX, Asia Mining, Endeavor Silver Corporation. So you did well on Nugget. Nugget's a cool symbol. Or I like Nugs too. Nugs is a cool symbol. And you can see it shows you right here. Well, on this one it doesn't show, but like you can punch in. You can punch in like GDXJ, then it'll show you what funds holds this. And I think Nugs was one of the ones that, or no, JNUG. This one is held by JNUG. So this fund is in JNUG. So that gives you even more research. So what's JNUG? Oh, it's the direction. It's a direction XX gold. I mean, my God, what's this up? 200% probably? Yep. Because the other ones were up like 120. So I figured this is up performance for the year. Yeah, 209, 3 year, 321%. Wow. And they have this GDXJ amongst other stuff. Oh, and the other stuff they use swaps for. Yeah, I'm learning a lot too. I'm learning a lot too. I'm learning a lot about closed-end funds. So when I first got into this YouTube channel, somebody said you have to read The Income Factory. And I didn't read it, but I went and watched a couple of videos on it, and that is a really cool concept. And so I have an appreciation for them, but it's just not my lane. I try to stay in my lane. My lane's the option trading, buffer funds and stuff like that. You're looking at DMAT for a future ETF purchase. Well, all right, let's check it out. Some kind of materials company. Yeah, I figured. So it's Global X Disruptive Materials. So this would be stuff like lithium probably and rare earth and stuff maybe. So let's see what they hold. Look at that thing, ALB. Southern Copper Corporation. So like industrial metals and stuff. So let's see who holds this one. Yeah, and it doesn't have anyone up. Some of them aren't held, I guess, by other ETFs, because usually it puts it right here if another ETF owns it. But then it's cool down. Have you ever gone down here? You can see the hedge funds that own it. And these aren't just hedge funds. These are market makers. The market maker is kind of like a hedge fund. Susquehanna is a famous market maker. They own 4.8% of this. So let's go here to let's go here to Alti. I always have to switch the topic back to something I know about or something I'm passionate about. So let's see the people that don't know. Yeah. So really no one. Those percentages are so small. These are just market makers that have a little position because that's less than 1%. I saw some influencer trying to say that some hedge fund was buying Yield Max or something. I mean, maybe, but I bet it was just a market maker that got stuck with the position. But I think it was on Tesla. Let's check Tesla. Or not stuck, but just has enough. You have to report it overnight. Okay, so Tidal has 7% of Tesla, but that's because they use Tesla in a fund of funds, right? So I bet that's the explanation for that. But yeah, some other influencer dug up something and try to make something out of this. I don't think that's that big of a deal, but I don't know. Maybe you guys know more about that stuff than me. You got to love Mondami's pastor. He knows who he's with. Yeah. Did you see that? He did. I thought he did a good job in the Oval Office. I thought it was a win for both sides. I mean, I watched that interview and watched some content on that. All right. KYLD is on my radar next month once margin maintenance drops. Yeah. I got KYLD and I just have my feelings hurt because I haven't made money on it, but it's not KYLD's fault. I bought the top. I think I got it November 3rd or something, November 5th. I mean, you know, what you going to do? I mean, yeah, because I got it just a few days after it came out. Anyway, it's fine. That's Howard does a good job. He can't make the price of gold go up, but Howard does a good job. The thing with Howard is, you know, if there's any way possible, there isn't always. You can't always control what the NAV does. I mean, they always say they try to keep them at that price, but they can't always control it. But to the extent that Howard has control over it, he's always going to try to be very reasonable with the way he manages his funds. He managed for growth first, in other words. Plays defense first instead of going on offense. He talked about KYLD the other day with Coach. I guess I didn't see I missed that interview. I also saw that Mike Coe was on with Roger Sands, but I couldn't watch that. I've seen Mike Coe talk so much, and I've done interviews. I know the answer before he says it. I'm not going to learn anything new from anyone interviewing Mike Coe or Jay Petrocelli. I mean, I know the answers, or I know what their answers are. Let's say I'm not saying those are the answers, but anyway. But Roger Sands does a good job. I'm sure it's a good interview. I started to watch it, and then I just it's the same old thing every time. I mean, the other thing is if you watch the Wolf Financial Spaces, that's not watch, you listen to it. You hear Mike Coe talk about the Yield Max funds. I've heard that probably for the past 4 or 5 weeks, an hour every day, and there's just no new questions. People will just phrase it different, but there's no new questions. All right. Now, who's protecting for real estate value? Oh, he's also protecting his real estate values. I guess I don't get that. But I think he's from San Francisco. I mean, he's probably trying to create generational wealth for himself. You have to have generational wealth to even own a 2-bedroom apartment in San Francisco. But yeah, Howard's a West Coast guy. All right, been pretty happy with K-Yield considering the market. Yeah, K-Yield, like I say, if Howard has anything to say about it, he's going to always be reasonable. Like I said, you can go by the brand reputation. The ones that have the reputation for giving you the best yield would be Granite and Yield Max. And then I'd say right under that would be Round Hill and then Neos and Rex. And then you have Curve. And yeah, that's just kind of their brand. Curve's just going to be the most conservative. Granite or Yield Max is going to be the least conservative, but the most aggressive as far as yield goes. Reinvest every distribution to preserve the NAV, huh? Well, yeah, you're talking about what Mike Coe says or whatever. Yeah, I know. What I'm saying is I've heard I'm not saying I agree with that or whatever, but I'm saying I know what the answer is before it comes out. Rod might do an interview with Howard a few months into next year, but nothing said. Oh, it's awesome. I plan to have Howard on like I used to have Jay on. I've already talked to Howard on. He's going to come on once a quarter or something. I used to have Jay on once a quarter. I mean, because, and actually but what I try to do is I try to wait till they come out with a new product that I want to talk with them about. Howard's coming out with the Bitcoin product. I don't know if you guys have seen that, KBTC or something, or KBIT. I don't know, but it's some kind of Bitcoin product. But maybe when that comes out, I'll get him scheduled to come on. But yeah, I'd like to have Howard as a regular guest. And, but I've also made arrangements with a few other people to have them on, 2 or 3 times a year. I'd really like to have Matthew Tuttle on again. And I'm going to have Matthew Tuttle on again soon as he comes out with his Income Blast series. We're going to get him on. Or maybe when he comes out that fund called Oh No. There's one called OHNO. But anyway, but I just try to correspond it with when something's coming out that I think you guys are interested in. I'm not worried about the clicks. Obviously, half the time I forget to hit monetize. I make lousy thumbnails, but I just like to get them on when they have something to talk about. I mean, the reason I got Howard on last time was because it's because of K Yield. K Yield was coming out, and I waited till it was coming out, and I made a day with him to get him on the show the day it came out or the day after or whatever, so he could tell us about it. And yeah, K Yield's been, I mean, all things considered, I mean, it's you know, I mean, Howard can't control everything, but the stuff he can control, he does a good job on. All right, EW, you're saying your weekly dividend stocks have underperformed lately because underlying assets have, like, yeah. If they could just make one of these where they paid you the yield, but that wasn't attached to the market. But these things, they have to write cover calls on something, you know, on some kind of asset. So they can write it on bonds, they can write it on stocks, whatever, but it's still attached to the future of that asset to some degree or another. You know. All right, have a good one, EW. Appreciate you. Appreciate you. I'm getting ready to get out of here too. Okay, Max, did you see Marcus Meal interview? Bad financial. Oh, I did not see that. I did not see that. It was a sad interview. I don't know what happened. Did she talk about losing her job or something? I mean, I hope she didn't talk about a dog dying or something. That's where I draw the line. I don't like to hear. I'll turn off a movie if I know a dog's going to die or something. Yeah, okay. Well, I mean, but hey, Amy's going to be great. She's a coder. Coders are in high demand. She could go get another job, or she could code her yield night, which is what she's doing, and get sponsorship, and she'll end up making more when it's all said and done. She just needs to keep her chin up. She's a talented person. I didn't hear that part of it. But yeah. I didn't hear that part of it. Well, God forbid the market we want the market to recover. But she's a good egg, and she's young. And she's a coder. She can, if she has to, she could go out. She could quit her YouTube channel and go get another job coding, and she'll be just fine. But yeah, I got you. No, I'm sure it's a good interview, but no, I have not seen that. I have not seen that interview yet. I saw the coach interview with Marcus, and that was a good interview. I like Marcus just fine. I was going to meet him in New York, but I didn't go. Yeah, it was a good show, but wow, yeah. Amy's awesome. I was actually on a live stream with Amy when she lost her job in real time. It was one of those Friday afternoon. Everyone was. She was on X, and she told everyone about it as soon as it happened. Anyway, yeah. But we were trying to, tell her, keep her chin up and everything. But yeah, that was devastating to lose your job in real time on X. If it would have happened to me, I wouldn't have said anything on X. I would have just gone, well, back in the old days, I would have just gone and drank a lot of beer or whatever and not told anybody. But that's not a healthy way to do it. But anyway, she just told everyone, because she was doing a spaces with us, but then she had a 12 o'clock meeting. And so she said, okay, I have to cut it loose. I have a hard out because I have a meeting at work. She works remotely, like a lot of coders work remotely. And so we were still shooting the breeze, me and Ambassador and some other people. And she came back on and said, well, guess what? I just got fired. And I was like, you're kidding me. Yeah. And these kids nowadays are so much more honest about stuff. If something bad happens to me, I'll probably keep it to myself. Anyway, that's why I have a drinking problem, or why I used to have a drinking problem. I was in the same boat, minus taking out loans, dividends cover monthly bills, and day trading for extra to stack some more income. Heck yeah, it's all about hustling. But yeah, when you're borrowing money and on margin and stuff, it's fine. It's fine as long as the market doesn't crash. But when you're on margin, you really can't have if an April hits, when you're on margin, if you can go 2 years and the market keeps going up, if you're doing the covered call funds or whatever, that's fine. But if you get into, like, you decide to go on margin, like in March, I mean, you might be wiped out before you ever get, even if you have a good strategy and stuff. Yeah. Risk controls everything. All right. Do you think trading whole stocks is a better plan than trading in and out of ETFs? Tesla has traded 186 days of $10 or more this year. I don't get the $10 or more. Oh, moved $10 or more. Well, that's a personal decision. I think that generally everyone should just, people that are under 50 and have a job shouldn't mess with the high yield funds. Maybe do some will strategies just for, to keep yourself going or whatever, but use your job for income and forget about the high yield funds. But then once you're 40 or 50 and once you save up some money and you've had some growth, then you can put some of that money into a covered call fund, like take a loan from yourself. But I think generally it's always better just to instead of messing with Tesla, to get Tesla, especially if you're 30, because Tesla's not going to grow. Tesla's going to grow. Yes, it's true that Tesla might give you dividends and you could reinvest the dividends in something that grows. And I get that you can hustle with the high yield also, but I think it's better to stay in, just stay in the individual stocks, but, and forget about the covered calls. If you have a job, well, once you're older and you don't have a job, the covered call funds make a lot of sense. Did I see that Walmart is transferring no, I did not see that. I saw that they did well on earnings the other day, right? Or they do bad? No, they did well, but they probably announced that with the earnings announcement. Kick-ass. So that's what I like to see. You trade the triple Qs. But in other words, even if you get, let's say you're doing the wills you'll say you're running a will on the triple Qs. Okay, if you get stuck with the triple Qs, that's fine. You're 33. Even if you run into an April, or even if you run into 2022, you can hold them because you have time to recover. But if you have the triple Q, whatever income fund it is, and you're on margin, you may not recover. So yeah, that's a great plan, Dylan. I love that idea. And I love that idea. Okay, so you're doing interest arbitrage there. You've taken out a 401k to pay yourself interest. Okay, sure. And you were buried in earnings. That might be on the NASDAQ 100. Yeah. So Tesla is for retirement. All I'm saying is Tesla can't grow because it's a covered call fund. So it's not only that it's totally capped. Forget about the total capped. NVIDIA is totally capped. NVDY is totally capped, and it grows. It can grow a little bit, but it's not going to be. But if you're young, you want to compound your money. These covered call funds they kill compounding, but you trade no more compounding for a current income. So, or let's say you don't have to be old. Let's say you're 40, but you had a good job. You're a coder and you retired and from Apple and you have $750,000 of stock or whatever. Yeah, you go get yourself $100,000 of a covered call fund, and heck yeah, and trade some of your, that you've already made for a little bit of income. Absolutely. I think that's a good use case. But when you're 30 and you don't have 700,000 saved up or a large amount of money, you want to have stock because you don't want to cap your upside. Stock is what compounds your wealth. Imagine getting Palantir 5 years ago. Imagine getting NVIDIA 5 years ago. It doesn't matter how good the covered call fund is. There's some out there that are really good that do a great job, but no matter how good it is, it's never going to do as well as the stock. So yeah, that's just my rule of thumb. And I have guys in my Discord, like Marcus is, he's not here tonight. I'm not trying to talk about him, but he's a young guy, but he uses these covered call funds. And so anyway, what I'm saying is, to each his own. I'm not the covered call police, but I just think when you're young, there's better opportunities. And also Marcus is extremely sharp. He's using the covered call funds in a very strategic way, and he's also using stuff like CAIE. So, but yeah, so if you use the covered call funds, just be aware it's a specific strategy. It's a trade. but just the general public, when you're 20 or 30 or 40, the general public is better off just having the Qs or the SPY or Palantir stock or whatever stock, because that's how you create generational wealth, is getting growth stocks that 10 or 20x over 10 or 20 years. When you're 50 or 60, hopefully you've already had some growth stocks that have 10 or 20x. So you can, but also, and you may not have a job anymore, or maybe you're too old to work, maybe you're disabled. Yeah. So, I mean, I've always said that the best use case for these covered call funds are a couple that's married and they both worked or whatever, and they have a little bit of money, but the wife wants to quit working and stay home with the kids. They could cash in maybe half of her 401k and knowing that they're going to lose upside, and they aren't worried about losing upside because they still have the other half of her 401k and all of the husband's 401k, but she can stay home with the kids, something like that. Or if a person becomes disabled and can't work, there's all kinds of good uses for these, but these won't create generational wealth. I mean, they'll create generational wealth for the guys that own the covered call funds, for guys like Howard and Jay and stuff, and the guy that owns, Round Hill is creating generational wealth for them. But the way for young guys to do it is just invest in growth stocks. I'm just a big believer in growth stocks. Okay. So what are you doing? I love this. You do the 10 over the 20 EMA, prices over the 50 for entry. Yes, I love that. I love that because it takes emotion out of it. You're taking second guessing, you can't second guess yourself. These are the rules. I'm going to buy when the 10 crosses over the 20. I'm going to set my stop loss, whatever, and this is my risk. But my reward on something, imagine if you would have bought when the 10 crosses over the 20 on NVIDIA and you bought it 5 years ago, you'd probably be, or a Palantir or something. Absolutely. I love the idea of using growth stocks. But if you want to have fun or whatever, yeah, trade growth stocks. But yeah, I love that idea. I love that idea. The best case is to invest. Yeah, of course, you should always, investing is always better. You don't want to put it in cash and put it under your mattress. That is definitely the case. You put it in something, even if it's just T-bills, put it in something, no matter what it is. And you're right, investing in covered call funds, even if you're 21 and it's your first job, is better than investing in nothing, for sure. So, and many young people, okay, now CLM isn't really a covered call fund. That's a different deal. So CLM and CRF are a different creature. They're an income fund, but we're not talking about covered call funds. I'm talking about Tesla and Alti and, and Biddy and Baggy and Maggie and all the ones we always talk about, covered call funds. But now VU and VTI, those are growth. That's the SPY. VU's the SPY and VTI is the world SPY, is the SPY for the world, and VU is just the SPY. But I think it's good what I would do if you wanted a little bit of income and you're young, break off 20,000 and start doing the will strategy to learn how to do it, and start running some will, get some SoFi stock, sell some puts, learn how to do it, try to create a little income, but keep your job, keep your 401k, learn how to do it. Then when you get older and your 401k is turned into $500,000, $750,000, $1 million, whatever, and you're 40 or 50, you'll be right there. You'll have experience. I mean, I'm a definite believer in income investing and that kind of stuff. And I'm a believer in do it yourself. If you, especially if you want to. But yeah, I agree too. That's a good one. Happy Blue Dolphin. I hadn't seen you in here before. Thank you for being here. All right, Eric, Max, have you ever thought about what ETF I would? Yes, that's all the time I've thought about what ETF I would create. In fact, that's all I thought about for a long time. It goes through different iterations, but my latest greatest is I would do an ETF that does lightning spreads. But it doesn't do daily lightning spreads, just does like weekly or monthly lightning spreads. But so it gets almost the same upside as the market and the same downside. But here's the thing that I would do that other ETFs wouldn't do. I would figure out a way to just pay out of profits. And there's not really a way to do that because ETF rules, you have to pay 90%. They have to give out everything by the end of the year, but I would have this. I would have a back test. and I would look at the past 12 months. So whatever strategy it is, I'm doing lightning spreads on the Qs. Okay. So the back test would show, I would have a benchmark. You would get a benchmark. You'd have an index company build you a benchmark or build your own. So you know that this strategy had a total growth. It doesn't matter if it's yield or NAV, whatever. It's CAGR, its compound annual growth rate was 20% or 24% over the last 12 months. Okay, so I would come out with the fund that month, and I'd come out with the fund in that first week. I would pay, or the first month, whatever. Just stick with me on the months. So it pays 24% a year. That's what the fund's made. So that's what the strategy's made, not the yield, just what it's made. So I would pay that first month. I would pay a 2% dividend because that's 24%. And then as the strategy kept rolling along, I would adjust it with whatever the trailing 12-month CAGR was. So the dividend that you were giving out would be coming from real earnings. Maybe not directly, but it would be tied to real earnings. And if you went into a multi-year bear market, your CAGR, your rolling CAGR would go down, but you would start paying less. You would cut. In other words, you'd cut the dividend to protect the NAV. And I just think that would be a lot of people want these funds to only pay you out of profits, out of actual money or whatever. So yeah, I would do something like that. I would do some kind of lightning spread where I got tons of upside, but I would set the dividends to pay you what you actually made. That's my idea. But yeah, it is a good question, Eric. I got a comment, Eric, from somebody in my comment section, and maybe you, somebody named Eric, and you said, Max, you did a bad job, or you didn't do a very good job explaining I was trying to explain a diagonal spread to somebody, and I did. That was a terrible explanation. Anyway, I don't know if it was you. If it was you, thank you. I'm gonna make it up to that guy. I'm gonna go find out who that guy was and try to redeem myself. But I bet I wouldn't be surprised if that was you, because I got a comment from a guy named Eric, and I knew it. I know, and you had a great idea. You said you should have started with the poor man's. That's right. That's exactly what I should have done. Anyway, I appreciate that comment. I responded to it also, but I'm going to redeem myself. All right, RJ, it'd be better if they had separate accounts at a different broker, one for growth and one. Yeah, that's a good idea too. That's a good idea. Okay, Dylan. Yeah, I did a poor job explaining it to you. All right. Well, now I know who it is. That's good. That's good. So I'm going to make some content. I'm going to make content. I'm going to make a 10-minute video that explains that properly, and I'll post it for everyone. But now I know, and I'll tag you guys in it. But yeah, Eric gave me a great idea, and yeah, I'm good. So now, because I felt bad about that. I felt bad about that. I usually do a better job, but anyway. And I do a pretty good job at explaining the buffer funds and stuff like that. But for some reason, that diagonal just got the better of me. But I just started off on the wrong foot, because then when I started looking at option strat, I was like, well, I would never do it like that. But I'd already set up the example, where I was trying to give it. It was a disaster. I'm going to make that up to you, Dylan. I'm going to definitely make it up to you. All right, guys. Well, I'm going to get out of here and go to sleep. I'm tired. I am tired. I'm beat. Losing my voice. Jackson, do you want to make an appearance? Who wants a treat? Come here. You want a treat? He's such a good dog. I'm going to take him for a WALK down the street, just so he can go to the bathroom, and I'll put him on his leash. We're going to walk a little bit. But also, that's the other thing. I'm trying to recover. If I start feeling better tomorrow, on Saturday, I take him on a long walk. That 4.5, 5 mile walk we go on. So I'm hoping that I feel better by tomorrow. So I'm going to get out of here, but I'm going to make content for you, Dylan. And then I'm going to make the top 20, be looking for the top 20 max factor. I'll record that tomorrow morning. And that's a good show too. It just looks at the top 20. All right. What are you saying here, Dylan? You sold Hood Leaps. Okay. You sold Hood Leaps and bought following month call. You bought back at the sold call for 40%. Okay. So you sold a call and then you bought it back at a lower price. You made 40% on the calls, and now you have some leaps. So you're getting, that's the concept of that's the poor man's covered call. That's the whole concept, is you're selling something to help pay for something else. You're short and long at the same time. It's almost like an arbitrage. It's just like a covered call. I mean, a covered call, you're long stock and then you're short calls, and you make a little bit of money if the stock goes up, but not too far up. You get the concept. Anyway, all right, guys. Well, I appreciate you guys for being here, and I will talk to you later.